Welcome back. We are moving into the fifth lecture of the module Portfolio Evaluation and Revision. This talks about the formula plans and what do you mean by formula plan, what is the purpose of formula plan, what are the different types of formula plans, and the advantages and disadvantages are some of the things which we would be discussing in this particular lecture. Let's first discuss about the definition of formula plan. So, formula plan, as the name suggests, it is based upon a formula. So, there is a systematic investment strategy to guide the portfolio management. So, it means to say that I have already identified a particular strategy to decide my portfolio. Okay. So, when I say that I am an investor, I want to take a decision on investing. I say I will be putting 10% of my money in bullion, okay, then 15% in shares, which is related with information technology, then might be 10% in shares in infrastructure, right, 5% in antiques, which is not indexed. So, like this I define my portfolio how it has to be, right. So, this is a formula. So, how the formula would be made? The expected return, whatever I am going to have, is nothing but it is the summation of proportion of investment in a particular stock I into the number of stock, right, plus summation means automatically it will come. So, only thing is it goes up to P and Xn, right. So, where Pi is talking about proportion, it could be either in percentage or it could be in terms of monetary value, right. So, I can convert in terms of percentage, monetary value in terms of my percentage, where I say 10% of my money I am going to invest in this. So, this is the proportion, and what is the value of that particular asset, that is this Xi. So, it varies. So, Pi is for bullion, Pi1 would be for share in IT, I2 would be this. So, like that I try to divide. So, it is a systematic investment strategy where a guide is already prepared, and based on predetermined rules and formula I am going to make a investment decision. So, what is the primary purpose of this formula plan? The primary purpose is to help the investors to get a desired balance of different asset types. It could be in terms of stock, bonds, cash, almost all different categories I am going to identify and divide it accordingly, so that it will help the investors to take risk which is in accordance with the financial goals, which is tolerant and in a market condition in which I am going to perform. So, these are some of the basics you should understand why a formula plan is required. And if it is not like a reactive investment is basically talking about short term market movements, or I can call this reactive as speculative, right. So, there is a difference between speculative and a formula plan. So, I am talking about investors, I am not talking about traders. Probably traders could also have a formula plan, but normally formula plan is for a long term basis, but reactive plan is for short term market movements, and I am trying to get advantage of it. But even if I am going to enter into the speculative market, and if I have a formula plan, then I would be adhering to set rules and investment decisions, okay, over time. What's a need for having a formula plan? The first need is to manage the risk. So, formula plan is actually designed in such a way that it maintains specific asset allocation to control the risk exposure. So, as I told you in the first slide, I put some money in bullion, I put some money in share which is focusing on infrastructure, in shares which is focusing on pharmaceuticals, in shares which is focusing on IT sector. Then some amount of money I would be investing in jewelry. In some amount of money I would be investing in antiques, like paintings or other monuments, whatever is available. So, I know that out of my total savings, what is the allocation which I am going to do, and based on this I can this is determined based upon the risk taking capacity, how much risk I would be taking, and based on that I would be identified what is the specific risk set asset in which I would be putting my money in. Okay, and the basic idea of having a formula plan is to have a balance between the different asset classes which is available, so that in the long run, even if one is not going to give you a benefit which you deserve, the other type of asset would be giving. Some types antiques would be giving you a better return than a stock which you are going to hold for a longer period of time, right? So, the formula plan will help the investors to avoid over concentration in any single type of assets. If you are going to have over concentration, it is a excessive risk. So, in a way, it is diversification of the investment percentage in various categories. Not talking in terms of money, we are talking in terms of the proportion of money which has to be invested in various asset categories. Second purpose of formula plan is to enhance return. So, the idea behind formula plan is always to have a long term return. Okay. So, it is a passive strategy, as we have seen in the previous lecture. It is a passive investment strategy where long term return and low buying and selling is the idea behind the whole thing. So, potentially we purchase it at a lower rate and we are going to sell it at a higher rate. Normally it happens in the long run rather than in the short run. Not bothered much about the short term variation in the stock prices. Okay, long term is one of the important aspects, and it also helps in balancing our assets. Sometimes what happens is I'm exceedingly holding a particular type of asset, I can rebalance it, and I can bring about changes in my formula plan where I'm just trying to reduce the proportion of a particular category of asset, and I'm going to change it to assets which can give me advantage over market cycles. So, let us assume that in the long run or in the short run, sometimes you find that there are certain categories which doesn't move in accordance to the expectation you have. So, various investment opportunities are available with you, but some of the opportunities over a period of time could become obsolete. So, in that case, what happens is you can think about realigning the formula plan where you can balance it by trying to putting more proportion into those assets which can give you a better return than those assets which was earlier classified as part of your portfolio with a higher proportion. So, that is the idea behind enhancing the returns. The third is you are going to maintain asset allocation. So, it is very clear that it is a structured approach where I am trying to include maximum of the assets, whether it is indexed or non-indexed, whether it is traded or non-traded, all those types of assets I have tried to identify and I have put into my formula, and then it is considered to be a structured approach of asset allocation management. Okay. So, here the investor's objective is to gain maximum benefit in the long term, and if there is a requirement, then the investor can do a rebalancing where the proportion of the portfolio investment can change so that you get benefit of market fluctuation as such. What are the different types of plans we have? So, formula plans, the definition told, it's run by a predefined rules and regulations. So, you have a guide which says that this is the proportion in which the money has to be divided, and based on that the investment is actually done. The only thing which the investor would have to do is rebalance the portfolio if suppose your fund manager says that there is a need for you to look into the aspects of those assets which are not as functional as expectation is, or for the amount of risk you have taken, it is not giving you the return which it has to give. So, in such cases, the investor will think about rebalancing the portfolio. Otherwise, it's governed by predetermined rules and regulations. And you can have different types of formula plan, and this is going to differ based on how to maintain the balance with the different risk and market trends which is prevailing. Okay. So, as I told you, you can have the proportion of money which you are going to put into the market in different assets. That could be one way, or I can also determine the proportion in terms of volume. How much volume of a particular thing has to be held at a particular point of time. So, both are in terms of determined in terms of proportion. So, I can change the proportion in either in terms of value or in terms of volume, but the ultimate idea is how I am going to manage the risk. But I have a formula in place, it is predetermined, it is ruled by all those things, but it will vary according to the market trends. There are three major types of formula plan. One is the constant dollar plan, constant ratio plan, and variable ratio plan. Let's see what they are. Constant dollar plan. As the name suggests, the investor is trying to maintain fixed dollar amount in each asset or asset category. So, here I say I am going to invest $100, it would be equally 100 would be given in various categories of assets, whatever it is, regardless of the market changes, right. So, very simple, determined. When there is a condition when one asset is performing well and is growing beyond the target dollar amount, then the investor will sell it in return for fixed dollar allocation. What does this mean? It means to say that if suppose there is an asset which is going beyond your actual expectation of return of whatever you have thought about, then you are going to deviate from it and you are going to sell those assets. So, that amount is reallocated in the, it comes back to the fixed dollar allocation. I am not going to put it in anywhere else. Target dollar amount would be the same, 100 would be same. I am just dividing this 100 into different categories, and one of the category, if it is not working, I will just shut it down, but this 100 will be divided in the remaining of the stocks which is available, right. So, asset decreases in value, the investor buys more to restore the dollar balance. So, that is something what you have understood from it. So, might be this, it says the proportion, if suppose I am not going to change the proportion, if suppose the price of this is decreasing, then I am going to purchase more number of shares of this, but the proportion would remain the same. Out of 100, if suppose 20% is allocated for this, I may purchase more number of shares if the price goes down, and if I am allocating 10% for this, and if the price goes up, I may sell some number of shares. So, but I will be maintaining 10% whatever I have already decided in the total amount which is available with me for investment. This is called a constant dollar plan. Next is constant ratio plan. Constant ratio plan, it says that a fixed percentage allocation between different asset rather than fixed dollar amount. So, here I am not talking in terms of value, right? Here I am talking in terms of the volume, or I can talk in terms of the proportion of various assets which I have to hold. It could be, basically it is more of a volume base rather than value, but I can convert it into value. But here it says the portfolio value changes due to market movement, but the ratio of the asset is going to remain same by rebalancing. It means to say that out of 100, if suppose 10% is allocated, I am going to rebalance it because of price change by either buying or selling the shares. But I am not going to deviate from it. It is very constant. I know what is the proportion of pharma shares, what is the proportion of infra stocks, what is the proportion of gold, what is the proportion of all these things. So, like that, if I am going to do that, it is understood that it is a constant ratio plan. This is almost similar to a constant dollar plan, where here we have considered it based on value. So, dollar is nothing but the value or a currency which we have identified under which we are going to invest. And this type of investment, constant ratio investment, is good for investors who wants stable return on the assets in which they have invested. Okay. So, it is basically, it says that whatever, without considering the value of your currency, let us assume your foreign exchange is varying and accordingly the price changes is also varying. I am not considering the price change in the currency forex rate, but I am just considering the amount whatever is to be given. If it is $1, $1, I am not bothered about the fluctuation between dollar and rupees and other things. I'm balancing it by change in the value of a particular asset at which I have to purchase and what I am holding, and if the price decreases, I am going to increase the number of shares, and if it is increasing, I am going to decrease the number of shares, balancing the whole thing. The next is variable ratio. As the name suggests, here you are not having anything like fixed proportion of anything. You are flexible, right? You are flexible in terms of both asset and based upon the market conditions. So, I am saying that today before investment, I take a decision that if 20% has to be invested in gold and 20% has to be invested in infrastructure, tomorrow based on the market condition, I can take a decision that 10% I can decrease from infrastructure and increase in gold. That way I am free to do it. So, such type of plan is called a variable ratio plan. So, this is normally useful when one type of asset is performing very nicely. In such conditions, the investors would increase the ratio of that particular asset, and those which are performing poor, they would decrease the proportion which is invested in it. Okay. And this is a dynamic process, and it changes ratios depending on performance and the market conditions. So, it's more of a speculative type of plan which you are going to have. I do not have any basics as to what I have to buy, I have to sell. I just do a basic survey of the economy industry, and within that I see that whichever is moving up or down, accordingly I am just going to put my money in. no fixed proportion into any particular set or category of assets are available in variable ratio plan. So it's very clear. Now coming to the comparison of these three types of plans, is considered to be a conservative approach. Your constant dollar plan is considered to be a conservative approach. Your constant ratio plan, it's fixed percentage allocation and it is consistent with exposure of each asset. Okay, so here also it is almost similar to the dollar plan. So I can put these two things together where it is for conservative investors and the allocation proportion is again fixed, and depending, it will change only depending upon the change in the prices of the asset. The percentage is not going to change, only the volume is going to change, right? The value is going to remain the same. And the third category is variable ratio plan, where it is ideal for investors who are comfortable with active investment strategies, who are ready to watch the market at various points of time, and depending upon the market conditions, they are trying to take leverage of it by investing in those stocks or shares which is giving you a higher return. You do not have any fixed proportion of asset class which you already have determined. So in that conditions, this is considered to be better, and they are active in nature and they want to take maximum return from the market in which they have put their money in. What is the advantage of having a formula plan? First is risk control. So depending on the type of formula plans whichever you have determined, you can have a control over the risk. So formula plan is basically designed to maintain desired risk level by systematically investing in those assets which is going to give you a better return in the long run. Okay. So constant ratio plan, as the name suggests, consistently rebalances the various asset class with risk tolerance. So that's very simple, as I told you. I'm not bothered about how a particular share is moving up or down. I'm just trying to hold on to those class of shares by either buying or selling those shares, so that I maintain a balance of the amount which I have invested in that particular asset class. Okay, and the other advantage is that there could be consistency, and this would help in protecting the investors. So if suppose I am having a constant ratio plan, then it's understood that how the investment has to be done, what is the category of investment I have done. Accordingly, I can protect the investors if there is any overexposure or underexposure depending upon the market criteria. So if it is variable ratio plan, then there is no problem at all, because you are meant for taking active decisions over there. Formula plan also encourages discipline. Why it encourages discipline? Because it is predetermined that what should be the proportion of money which you are going to put into different classes of assets. It is already known. So if the prices go up or down, you are just going to change the volume over there. So it encourages discipline over there, because there is a predetermined rule, and the formula plans talk about a disciplined investing. Okay, these are meant for those investors who are less likely to make impulsive decision, because the markets, when it is highly volatile, it may go up and go down in the short run, but what happens is in the long run, this may not have much of a impact on the overall thing. So my situation is depending on whether I am a active or passive decision maker, and whether I am talking about a constant ratio or a variable ratio. I am just going to change the proportion of volume rather than the value. So I am taking direct advantage of the changes which is happening in the market, because already I have included all asset categories which has to be part of the portfolio, and it's defined, and I'm just going to change whether I have to purchase or I have to sell so that I maintain those proportions. So that is what is there. So it is a disciplined way of doing things, and it is useful even in a volatile market where emotional reactions may lead to investment losses. Okay. So since it is disciplined, I am not bothered whether the market is volatile or not. If I am going to behave in that manner, then I may enter into a loss. So that is another important aspect of it. And this also indicates selling high performing asset and rebalancing and holding the others without any emotion. So as I told you, I have divided 100 into different categories, 10, 15, 20, like that, right? So this percentage is going to remain the same. The volume is going to change, right? Number of shares is going to change. That's the only thing. So how did I identify these shares? It is based upon the research which I have done, based upon the performance of that particular asset. So that is what I have to do. It reduces emotional decision making. Sometimes the market may behave based on information. In an efficient market, all informations are available at all point of time. So emotional decision making can happen in certain criteria situations. I just want to come out of it by a formula plan where I am not going to go by any emotional things. And formula plans will reduce the biasness by removing the subjective decision. So, I am not going to take any subjective decision. Everything is based on research. I have identified the asset categories, and the proportion of investment which I have to make in those asset categories is identified based on the empirical research, not based on subjective decision. And here, by using formula plan, the investors can just do the rebalancing activity so that they get maximum return. You are not emotionally attached to it. What is the adaptability across profiles, investor profiles? It is very simple. Formula plans, you have different types. All the three types are there. So it becomes equally applicable to any of the investor types, whether it is conservative or whether it is risk bearing ability, whatever it is. So conservative approach may prefer a constant dollar or a constant ratio plan, and the person who is highly risk tolerant would go in for a variable ratio plan. And the flexibility makes formula plan suitable for wide range of financial goals, because at the end of the day, if you have a diversified portfolio and in the long run, if you want to take a return, this is a disciplined way of making money out of it. The disadvantages of a formula plan, as you can understand, is missed opportunity. The markets will move up and down continuously. You are fixed to a particular category of assets for the long run. So you may miss upon one or two of the situations where one of the shares is moving up, but it is not part of your asset criteria. So that is the disadvantage of it. And rebalancing, if suppose I am going to either buy or sell in order to maintain the proportion of investment which I am going to do, you may incur higher transaction cost, because if suppose any of those assets are frequently moving up or moving down, then you may have to either purchase or sell those set of assets so that you maintain the per unit category, the proportion category. And there is complexity of execution. It is more likely to happen in variable ratio plan. Otherwise, it is quite simple and it is useful. Choosing the right plan, what is the right formula plan? It is dependent on various factors. It is dependent on investors' risk tolerance. It is dependent on the time frame for investment and the ultimate aim of your investment. So depending on this, you will have to decide whether you have to go with a constant plan or a variable plan. And whatever plan you have, will depend on the investor's profile, whether the investor's profile is conservative, moderate or aggressive. Depending on that, I would be selecting the right plan. So in this particular lecture, I have tried to talk about the reason, the idea behind having matrices, whatever we have seen in the previous lectures where we talked about portfolio evaluation. You have a matrix. You have different category of investors called active and passive investors, but you also have something beyond that where I can say you can have a fixed proportion category of investments which could be done, which is called a formula plan. Accordingly, depending on whether you are an active or passive investor, or depending on the movement of asset prices based on your research and other things, in the long run, if you feel that a particular class of asset is going to give you benefit, you can keep a proportion of your money to be invested in those asset classes. So the diversification becomes larger if you have a formula plan in place, and that is going to help you in the long run as an investor. Thank you.